Good day, colleagues. How are you? This is John Herrera, president of MuniTents, Municipal Staffing Solutions, and today with the City Speak blog and podcast. It's entitled, Happy Days Are Here Again, because interest rates are going up and cash is no longer trash. Cash is king. Don't turn me off. Give me just 2 verses to sing of a little song here called Happy Days Are Here Again. Okay, it's my only number, so let me sing 2 verses. Happy days are here again. The skies above are clear again. Let us sing a song of cheer today. Happy days are here again. Yes, happy days are here again. If you're a saver, if you're an individual or an organization or a city government or a local government with cash, you have something to sing about now because cash is no longer trash. Cash is king again. Cash is making interest and is providing real significant revenue, interest revenue for the general fund and the special funds of the city. You know, I've been a city treasurer for a long time and I've had to wait 10, 15 years or longer to see the kind of interest earnings, the investment yields that we can realize from investing our idle cash. And you know, right now that we're having all this conversation about the Silicon Valley Bank, the default, right, of that bank, Signature Bank, getting taken over by bank regulators. This is a good time to be talking about finance and banking. So give me a few minutes of your attention. Now, right now I'm just doing a 10-minute presentation for LinkedIn. But if this is of interest to people, I may go beyond the 10 minutes. So for those of you that are on my YouTube channel, City Speak the podcast, stay with me after the end of the 10 minutes. Here we go. Cash flow management is more important than ever. Okay? Taking an interest in your cash results in interest earnings that you didn't have last year. Cash was trash for many years. But now cash is king. Cash is making very substantial gains to provide interest revenue for the general fund and the enterprise funds and other funds of the city. Now, I'm not going to talk about the fact that when interest rates go up, borrowing costs also go up. Not the same for municipal organizations, obviously, because we issue tax-exempt financing. Mostly we issue tax-exempt financing. What I'm talking about is the happy days that local governments that have cash, most do, are now able to make good, serious interest earnings. So it's time to go back. Go look at your bank. See if you can move monies out of your bank and into the local agency investment pool, local agency investment fund, some other pooled, safe, risk-free investment. And then look at seeing if you can move monies out for 6 months, 12 months, 18 months, 24 months. I don't think you want to go beyond 24 months because we have an inverted yield curve where you're actually making less investment earnings if you go out beyond 24 months, about 24 months. So I just want to talk briefly. Yes, these are really happy times. One of the city governments that I work with, we have a portfolio, a cash balance at our bank. We have $50 million in cash, about $50 million. In March of last year, just 12 months ago, just a year ago, we were making about 0.2%, 0.278% at LAIF, Local Agency Investment Fund. Today, we're making 2.79%. That's 10 times the investment earnings we were making just 1 year ago. And that's amazing. Really got to think about this. Now, for a portfolio like we have with our bank, which was not even paying us 2%, by the way, our bank wasn't paying us very much. If you don't pay attention to your bank accounts, the banks are not going to pay you much, if anything, because they don't have to. You have to make sure you go and approach them and negotiate what you want to make in interest earnings. But again, just talking about LAIF, in March of 2022, we were making less than 1/3 of 1%. Today, we are making 10 times that amount. So for our $50 million at LAIF would give us about $139,000 for the whole year. Today, if we put those same $50 million, we get $1,395,000. And it keeps going up and up and up because rates are going up and up and up. Now, if you were to move monies out into buy US Treasury bills, Treasury notes, and Treasury bonds, you're going to be making over 5%. Some of the government agencies, which again are fully risk-free because they're backed by the full faith and credit of the United States government, but Fannie Mae, Freddie Mac, Home Loan Bank, all of those agencies, they're paying up to like 5.7, 5.8% for about a 24-month maturity. Can you imagine that? And that means that on $50 million, if we were to be able to invest it over the next 18 to 24 months, we'd be making $2,840,000. That's almost $3 million for the general fund and other funds of the city. And in a time when we're trying to balance our budgets, interest earnings are going to be a big ticket item now on the revenue side of the Budget Balancing Act. So going from $139,000 in annual interest earnings on our $50 million to now making almost $3 million, that's amazing, guys. That's why I'm singing the song, Happy Days Are Here Again. Yes, it's totally exciting. I do want to talk briefly about the fact that now you got to be focusing in on any receivables, any money that's due to your city, your local government organization. Get that money in just as quickly as you can. And as far as making payments, slow it down as long as you can. At my cities, we have a net 30 payment terms. So wait 30 days, but get them paid on time within 30 days as far as the vendors. But from our customers, collect that money just as quickly as you can. Okay, that's another concept. One more concept I want to point out is the SLY, S-L-Y, S-L-Y. S stands for the safety is number one consideration before we make government investments. L stands for liquidity. How long do you want to make the maturity of the investments? You don't want to end up with a liquidity issue. And yield is third in consideration. So we don't consider yield. First, we consider safety. We want to have the highest safety. Liquidity is second, and yield is lowest. But we want to maximize our yield that we make, the interest rates that we make while maintaining safety and liquidity. If you hold your investments to maturity, you don't have any risk of losing principal. I'll talk more about that in the expanded version. You only lose principal, again, if you try to cash your marketable securities to sell them before they mature in the liquidity and maturity level. Another point is, remember that when interest rates go up, the value of bonds go down. I'll talk about that in the expanded version if you stay beyond 10 minutes. Transaction costs. Hey, balance it out. It doesn't matter that they charge you wire transfer fees to wire money back and forth to LAIF, local agency investment fund, or any other investments, because you look at making more interest from the constant investing of your investments, of your cash balances. Maintain a daily bank register so you know where your cash stands every single day, so you can move monies back and forth and actively be involved in your portfolio. Look at your budget. Make sure that you look at your CIP budget, which tells you when you need large dollar sums. So when you look at your maturities and how far you want to invest your investments, your cash, is based on CIP budget. Look at your operating budget. Why not create a budget where you enter your budget on a monthly basis, not just for the whole year, but most accounting systems allow you to actually go in and enter how much you're going to spend by month of the year for every department and how much money you're going to be bringing in for every month of the year of the organization. So know your operating budget needs versus your capital improvement needs so you can build a cash flow budget and maximize investment earnings. You want to ladder your portfolio 6, 12, 18, 24 months. Don't go beyond 24 months right now. Think about that. City and local government bank deposits, they're collateralized by letters of credit, but you need to know what are the underlying securities. Look at that. So are you ready to take an interest in your cash flow management? Because now more than ever, you can realize good returns for your budget. All for now, John Herrera with MuniTemps and City Speak, the podcast. Now, those of you that are still here, stay with me, okay? Because we got a little longer term video to go into this notion of cash management. And happy days are here again because we're making interest earnings. Thank you. All for now. Give me your comments. I love to hear what you guys have to say. Okay, bye. All right, very good. So thanks for those of you that stayed with me. Let me go into a little bit more detail, okay? If you want to learn a little more, maybe you're already familiar with it, comment if you can. But in this City Speak blog podcast, I want to talk with a little more time now. Yes, it's happy days. Happy days because if you have cash, and not just as an organization, a city government, a nonprofit organization, but even as individuals, you got to get involved to maximize interest earnings. You got to invest while maintaining safety, liquidity, but look at making the most yield you can safely. We have an investment policy in local government that allows us, that defines where we invest our money. I keep it real simple. The KISS, the KISS, KISS principle, that's what I follow for investments. And basically, I just keep the money. I need to keep the amount in our checking account that we need. We have a sweep account, which also pays very good interest, above 4%. So when you don't need the monies to pay the bills, the operating costs, the bank automatically sweeps the balances, their excess balances that are needed beyond the maintaining the service charges and cost of having the bank account into a sweep account. Then beyond that, I move money sometimes into LAIF, Local Agency Investment Fund. Highly liquid monies. They're now moving up towards 3%. I think it's 2.79%, but they're moving towards 3%. And I think they're going to go up higher if this trend of higher interest rates continue. We don't know what's going to happen, but right now, take advantage of the higher rates. Lock them in for, do a ladder portfolio. So invest some in 6 months, 12 months, 18 months, 24 months, and you try to capture as much of that growth in the interest earnings as you can. As I said before, that of course we benefit in terms of interest earnings, but over on the cost side, you also have a little bit higher borrowing costs because those tend to go up as well. I gave this scenario earlier where I talked about cash. It used to be trash, but now cash is king because we're earning interest earnings. And as an example, I gave you the example, our organization, one of the organizations that I work at, we have $50 million. Another one we have, I think, $30 million. I work with a number of different municipalities, and I try to help them with maximizing their interest earnings while maintaining the SLY principle, right? SLY, in that order. S, safety, L, liquidity, Y, yield. You can maximize your interest earnings just by simply observing the safety, maintaining highest safety level, while also maintaining liquidity. Don't invest beyond when you might need them. Because, for example, let's say you put the entire $50 million and you put them out for 24 months, right? You buy 24 months worth of US Treasuries. By the way, you can go to treasurydirect.gov and you can set up an account there and buy treasuries there directly, or you can go through a broker. Your bank has a broker where you can buy bonds, original issue bonds, right? When they come out, there's going to be an auction for US Treasuries on March 27th of 2023, and the settlement is on March 30th or March 31st, I believe it is. So you can buy treasuries directly from the federal government or from the government agencies like the Fannie Mae, Freddie Mac, Federal Home Loan Bank, Farm Credit Bureau, and other agencies, okay? Or you can also buy them, as I said, Wells Fargo, Union Bank, JP Morgan Chase, different banks. They can give you a quote on how much it'll cost to buy these investments, right? They're risk-free and that they're government bonds that are backed up by the full faith and credit of the United States government. But you want to look into these because there's great opportunities out there, and give me a call or send me an email, John, John, @munitemps.com, and I'd be happy to share with you everything you ever wanted to know, but we're afraid to ask about investments, investing public dollars, investing public funds. I'm not going to give you advice on how to invest, but I tell you how I do it and how I have hundreds of millions of dollars under my responsibility as a city treasurer, as a municipal finance officer, and I follow the SLY principle: safety first, liquidity next, and then yield to go from earning just a few $100,000 in interest earnings to making millions of dollars in interest earnings. And it's really not that difficult. You just got to sit down and understand it. What you don't understand, you fear. So you can also obviously get involved with the CMTA, CSMFO, whatever, the GFOA. There's all these different municipal trade organizations that they have different people that get involved, and they share their notes as well. But again, I'm not telling you what to buy. I'm telling you what we buy. And many people are, there's a flight to safety, right? Because some people are afraid of what's going on with banks. So I urge you to really consider looking at your bank balances. Remember, FDIC only insures the first $250,000 of investments, right? If you have more than $250,000 in a bank, which I know you do if you're a local government agency, go look at how those deposits are being collateralized. And I know that there's probably going to be letters of credit, right? But what is the underlying security? What securities are underlying those letters of credit? Find out, because just like what happened in 2008, remember September 15th, was that Lehman Brothers? They just went bankrupt. There's a lot of weird stuff going on right now. It's like the United States of America, our economy is at a major crossroads, and this is pretty significant what we're seeing right now with the interest rates. And that's going to cause a lot of tectonic shifts in our economy and our banking system and the way we, fiscal policy and monetary policy is balanced. And so you got to be informed. You don't have to be an economist or a PhD in macroeconomic theory or anything like that. Really, it's just practitioner notes, and I've been doing this for over 30 years, so I'm pretty comfortable with what we need to do and how to stay out of trouble. Don't follow the crowd, okay? You can go back and look at the story in the 1990s. Robert Citron, who was the treasurer from County of Orange County, California. Remember, the County of Orange went bankrupt, and many local governments and city governments that deposited their money there in the Orange County investment pool, they lost millions of dollars. And even though later they had to wait years to recover a lot of that money back, but it was all because, oh wow, look at all these high earnings, but these were earnings at above market returns. I'm not in search of anything that's above market. I'm just looking to earn market. And the market, it's high. So it's happy days again for savers, especially people who are older and they have cash balances, which have been earning nothing. A lot of senior citizens have been having to go back to work because their money was trash. There's senior citizens that had $250,000, $350,000, and they were earning nothing, a pittance. So they had to go back to work. They were greeters at Walmart and do different kind of jobs because their cash balances was not providing them the kind of returns that they used to earn. So now the interest rates are going up 5-6%, risk-free. That's the beauty of all of this, that there's no risk because we assume the United States of America, right? Full faith and credit of the United States. So it's a really good time to be investing in government bonds, government notes, government bills, agencies like Fannie Mae, Freddie Mac, Federal Home Loan Bank, and other related government agencies. LAIF, the local agency investment fund, is providing a really good return right now. So consider going to talk to your banker. Now, he or she is going to try to tell you, oh, I can get you more interest. I know we're only paying you 1.5%, but I'll give you 4%. And I'm thinking, hey, why didn't you tell me that last week? Why is it that you're only telling me about this additional interest that you can make for me so I don't take the money out of your bank? No, you should have done this before. But see, if you don't ask questions, they're not going to do anything for you. The money's going to sit there. The bank is making some kind of profit on that money, not as much as they in the past. They couldn't make very much. But if you don't talk to the banker, if you don't ask questions, okay, by inquiry and observation, you raise the accountability of your banker. And certainly they're going to be doing everything they can so you don't take your money out of there. But I'm talking to my city manager, my general manager, my CEO, and saying, we got to move monies out of the bank and put them in the local agency investment fund or some kind of investment pool. And then from there, when I finish meeting with my department directors as we build the budget for next fiscal year, we're going to see what capital projects are going to be coming online, being completed. So we have the money, we have the cash for paying the contractors. But that may not happen for 6 to 12 to 18 months. So we're going to do a schedule, a project schedule with the public works director, community development director, and the city manager's office, so we can see when do we need to have this cash. Because if I don't need this cash for 2 years, I'll invest it and I'll make 5.8% on that money. Okay, so let me now talk about buying investments. There is no risk on the safety because it's backed by the full faith and credit of the United States government. What about liquidity? Is there risk, liquidity risk? Sure, there could be. If you don't do a good job of budgeting your cash needs for the next 6, 12, 18, 24 months, and as I said before, because the yield curve is inverted, which means you earn less interest earnings beyond 24 months. I'm not going to go beyond 24 months. I have no need for that right now. I'm staying in a short-term window of 24 months or less. But you ladder the portfolio of how you invest those monies so you have monies coming due. Of course, the issue is that you have to reinvest the monies at that time when they mature. So nobody has a crystal ball. So you ladder your portfolio. You buy your investments 6 months, 9 months, if you want 12 months, whatever you need. When you think when your projection for when you're going to need cash, you project it out and make it line up with your 5-year capital improvement budget or your 2-year capital improvement budget, as well as your 1 or 2 year operating budget, and you project out your cash flow needs that way. It's really not that difficult. And in my 33 years of working in city government, I mean, I've been right on target within 9 months, because it's not just my estimates. It's also the estimates of the public works director, community development director, library director, city manager's office. Everybody gets involved so that we can have a forecast of consensus where all of us managers get together. Then the other thing that happens is that once the monies are committed over a certain period of time and they're invested in certain maturities, like I said, 6, 12, 18, 24 months, typical for me how I ladder my portfolio, the projects end up lining up about in that kind of a schedule. So who better than the public works director to know when capital projects are going to be done? The city engineer, right? The department directors. So, but when it comes to talking about holding to maturity, you got to do that. And then you don't have to worry about losing capital, principal, right? Because let's say, for example, that you had to sell $10 million worth of government notes, treasury notes, right? Because you had a big project, you got to make $10 million worth of payments to a contractor, and let's say that those treasury notes were not to be maturing for 24 months, but you have to cash them in, you have to trade them before the 24 months. Well, what happens is, depending on the rate that you have, in our case it's 5.7% bonds, and you need to sell them, but let's say the interest rates have gone up even more. That means the value of the bond is going to be less because the coupon rate for the bond is less than what the market rate is, assuming that's the scenario. The opposite is true. If for whatever reason you have bonds that are paying 5.7% for a 24-month maturity, if interest rates go down, then you had to sell your bonds early, well, you can sell your bonds for a gain, right? But other than that, if you hold your bonds, your government bonds to maturity, you might have, there might be interest rates go up and down and affect the value of the bonds, but they're unrealized. There's no, it's like a house. My house went down by 30%. Who cares? If you don't sell it, you don't have a loss. You only have a loss if you sell it. Same thing with investments and securities. Also, remember what I told you. It's a very easy formula. When interest rates go up, the value of bonds go down. Okay. That means bonds that have already been issued. Unless you go out there, you have two choices when you buy bonds. You can buy original issue, right? Original issue, like the US Treasury is going to be selling bonds on March the 27th of 2023, and they'll settle up on March 30th. You got to pay for it by then. But those would be original issue. There is no discount or premium on those bonds because they're going to sell at the exact market rate, and the coupon rate is going to be market, right? But you can also go buy secondary market bonds that they're maybe 5 years old, 8 years old, 6 years old, whatever. You're going to look at the coupon rate of those bonds compared to the market rate at this time, and that then will determine whether there's a premium or a discount on those bonds, and you buy them at that price. It's no difference because the equivalent yield and the present value of those bonds equals the same. So anyways, bonds values go up when interest rates go down. Right now, interest rates are going up, so the bond values are actually going down. So one other thing I want to talk about, a daily dashboard of your cash, daily bank balances, like a little mini daily bank reconciliation. Look, I know that my bank reconciliation from February 28th of 2023, I know what my starting cash balance is. So if every day I spend 5 minutes to go in the bank to see what deposits went in, what checks were issued, what checks were cleared, any bank charges, any ACH deposits that come in from the state or from the federal government or whatever, and I know where my cash stands every single day. So do you think that I know how much I can invest? Absolutely, because I know where my cash is every single day. I don't wait for the end of the month or even more than a month, okay? So daily cash dashboard, you need to know as a city finance director, a city treasurer, or even a city manager, you need to know where your cash stands every single day, but no later than as of the end of the last month. Okay, another thing is a cash flow budget. I already talked about this. There are two main budgets that we use to try to estimate our cash budgets, our cash flow needs for the next 6, 12, 18, 24 months, or even longer once the interest rates stabilize, hopefully, right? And we have a upward yielding yield curve for the interest rates. Not like right now, it's inverted. I don't like that. There's something weird that signals for many people a recession, a serious recession coming, but we'll see, let's pray. In the meantime, tie down everything and brace yourself and follow prudent financial management, and we're going to be okay. But the two main budgets that drive our cash flow needs for the next 2 years, even up to 5 years, is the budget. You have the capital improvement budget, the CIP budget, and you have the operating budget. The CIP budget tells you the different projects that are scheduled to be constructed. So you need to know how much you're going to need every month of the next 2 years or 5 years. You need to know, and you will know if you look at the CIP budget. The same thing with the operating budget. You know what the operating needs. And if you go into your accounting system, when you're building your budget and you're looking at your accounting system, you can see how much cash is needed every month. Your expenditure budgets by line item, you can enter by line item, but also by month, how much is going to be needed. On the revenues coming in, you don't just enter one total for the year, you can also break it down in your system by month. When does property tax come in July, August, September, all the way to June, if you're a June 30th fiscal year? Everything is within the budget module. Learn to use the budget module in your accounting system. It's very powerful, especially the monthly projections within the system. Ladder portfolio, I already told you the way I like to structure it is 6, 12, 18, and 24 months. Whatever works for you is driven by the CIP budget and the operating budget and other cash flow projections. So as you talk to your banker, wherever you bank, whatever bank you bank with, okay, obviously our president said that all deposits are going to be insured. I don't know what that means. To me, I'm going to make sure that I talk to my banker, make sure that the collateral, underlying collateral, whether they're using letters of credit or anything else, know what the underlying securities are for those letters of credit that are collateralizing your bank deposits. You probably have millions, tens of millions or more. Okay, so you got to look at the security and try to diversify, have more than one bank. No matter how wonderful your banker is, your cash is more wonderful because it belongs to the residents of your city. Okay, so take that serious. It's no joke. I had to tell my banker at one of my cities that I work with in LA County, I said, man, this is no joke, dude. I mean, I don't care how nice you are. Money is more important than your nice smile. I'm sorry. But I'm not sorry. That's not what I mean. I'm sorry to whoever else, likes you working with this bank. But at any rate, that's all I need to say for now. Call me or email me, John, John, at munitemps.com, or get my contact information going to munitemps.com. And I'd love to be able to spend time with you and tell you how you can maximize the investment earnings for your local government, for your municipality, for your city government, without jeopardizing the safety or liquidity of your organization. I'd be happy to help you with. Just get a hold of me. I love talking about this stuff. I live, eat, and breathe municipal finance. And right now, happy days are here again. Interest earnings are up again. And whether you're an organization, a business, a nonprofit, or an individual, you are happy that your cash is now going to work for you. Cash is no longer trash. Cash is king. So are you ready to take an interest in your cash management? Go do it. John Herrera, Muni Temps, and the City Speak blog and podcast. All for now. Bye-bye.